Welcome to the Expert Network Team podcast,
where our goal is to inform and educate our listeners on matters related to finance, legal, insurance, accounting, and other interests that are of personal and business nature.
We hope you will find our content useful as well as entertaining. The Expert Network Team consists of Karl Frank of A&I Financial, Mike Miller of Miller and Associates CPAs, Jeff Cromendike of Security First Insurance Agency, and I'm Nathan Merrill. I'm an attorney at Goodspeed & Merrill.
Together, our independent team combines our expertise to provide you insights and solutions, some straightforward, some profound, for real-life opportunities we see on a daily basis. We hope you enjoy the information contained in today's podcast and find it useful. If you'd like to learn more or desire to meet with any of the Expert Network team members in person, you can contact us at info@expertnetworkteam.com. That's info at expertnetworkteam.com.
And we encourage you to take advantage of a free consultation with any of our team members. Just mention this podcast when you schedule your appointment.
Now on to today's podcast.
Welcome, everybody, to today's podcast. I'm Karl Frank, and with me today I've got Nate Merrill. Hi, Nate.
Hi, how you doing? Great to be here.
Good. It's great to have you. And remotely, but sounding like he's in the same room, Mike Miller, CPA. How are you, Mike?
Good. How are you guys doing today?
We are doing great. Whoa.
There's not even time delay there. He's all the way in Austin. And
This technology is amazing.
Love it.
Love it. Well, we can see you in the room on a very big television screen. It's just like you're here, my friend.
For those of my clients who didn't know, I did move to Austin, but my office is still in Denver.
Congratulations, man. What a year. What a huge year of change. And today I thought we would just kind of save our brains, save our backs, and talk about investing 101, really diving into retirement accounts, how they're taxed, and tax savings. It's a real basic understanding that I think we were never taught in school.
Never taught. Plus, when you think about the topics we've covered lately, we've been dealing with some pretty heavy hitting concepts and strategies. So reverting back to some of the basics, especially for folks who don't have all those other things applied to them, I think will serve everybody.
I think it's a great idea. If you're willing to go there, I'm willing to go there, and we'll just go and ask some basic questions. So I'll ask the first one, and then we can just start there. So what's a retirement account, and how is it different from a regular account, any sort of investment account?
I'll start with the technical definition. Technically, what a retirement account is a account established under a qualified retirement plan, usually referred to as a 401k, and or an individual retirement account established under similar code provisions. But either way, they are unique in the sense that they are qualified under the code and therefore enjoy some very particular tax benefits or characteristics associated with them.
Well, that sounds great. Mike, being our tax expert, maybe you want to dive in there. What are some of the tax benefits of retirement accounts?
Well, you normally have that coming through like a payroll deduction when you're an employee, right? Because the qualified plan is for the employer. And so the employees are deferring a portion of their pay, whether it be, whatever the pay frequency is, whether it's, once every other week or twice a month or whatever it is, they're deferring a certain portion of their income out of their paycheck into the 401k plan. And they don't pay taxes on that. It's deferred. So that's kind of a nice perk. And if the employee or the employer is doing any kind of match, that's free money. It's not taxable to the employee, and it's a deduction to the business. So that's an easy way to get some free money.
A match, just to jump in there, is one of the features that the code tends to incent. There's profit sharing, there's match. There's two sides of the qualified plan construct. One is the deferral piece, and the other is the employer contribution piece. They don't always go together, but they're often rolled in. So as Mike points out, in a qualified plan setting, you can get free money from your employer for just participating in the plan. Mike, do you want to explain why they would do that? Why would an employer want to give that free money into the plan?
Well, from my perspective in my career, it's a great employee retention tool. They get a business deduction for it, but I don't think they use it for that. I think it's more of a, let's be competitive in the marketplace and offer that perk because everybody else is going to offer it. We should be offering it. And
the
again, to
retention
retain
side
the
is,
employees, retain your top talent.
yeah, and the retention side is because that money isn't always vested on day one.
Right. I've usually seen 3 or 5 years. I haven't seen too much shorter than that, unless
Right.
it's a small company with a safe harbor, maybe it vests immediately
Right.
because of the size of the company. But for the most part, big corporations are usually 3 or 5 year vesting to maintain and keep the employees there.
And then getting more participation in the plan allows the higher compensated employees potentially more deferral opportunities for their salary, does it not?
Yeah, you get into some complex discrimination rules. Karl probably knows a lot more about those than I do, but if depending on your employee base and the wages and who's participating in the plan, you as a quote unquote highly compensated employee may contribute the full amount to the plan, which 2021 is $19,500. They come back in, the custodian of the plan comes back in, does an assessment of who's contributing. And if it's more favorable to the highly comped employees, they'll actually retract some of that 401k contribution, and you got to retract it and claim it back into income, balance it out.
From the basic employee's perspective, it's a deferral and some potential retirement incentive money.
I love it. What can I invest in inside my company's 401k? And I can answer
It varies. I mean, there were some employers back in the day that 100% of it had to go into the company stock. I think Enron kind of showed us that you don't want to do that. And now the plans that I'm aware of, they go into some custodian, whether it's, Invesco or Charles Schwab or wherever they have the plan set up. And then they give you a range of funds to invest in.
A lot of the push has been towards the target retirement date funds.
It seems like that's becoming more popular, and certainly I can talk about the pros and cons of that. Are there things I cannot invest in my 401k?
Real estate.
Real estate, right? I mean, that's the big one I was thinking of. I couldn't do that. Gold, I can't invest directly in gold. I can buy an investment ETF or fund that tracks gold, but I can't own physical gold inside my company's digital 401k account.
Now comparing the 401k to the IRA, you can set up self-directed IRAs that can do those sorts of things, but then you have to figure out a way to get your money out of the plan into an IRA. Easiest way is to terminate, to roll it over. But unless your plan, and it's pretty rare, allows for in-service rollovers to IRAs, you're stuck with whatever the plan offers you as investment options.
But there's a huge array of investments that I can put my money in. I could even put it into cash and leave it alone.
And for the kind of mainstream investor, everything you'd probably be appropriately investing in would be available in a 401k.
Would be available inside the 401k.
Because I don't know, I'm not an investment advisor, but you don't tend to branch out into those real estate and gold and that sort of stuff until you have your kind of core investment portfolio built.
I sure hope not. Anything else about the 401k that we should know about?
Access.
And
you and I have talked a little bit about this because some of these rules have been changing as a result of COVID emergency measures, that sort of stuff.
How do I get at my money?
I don't know all the ways. I just know some of them. So there's hardship exemptions. Like if you fall on financial hardship, you can potentially qualify to pull money out without the penalty. If you pull it out early, before 59 and a half, you run afoul of their penalty structure. And so you're not only going to be paying the tax on the deferred income, but you're going to be paying an additional penalty. So you don't want that. But if you can get it out for a hardship exemption, isn't there a first-time home purchase? There's sending your kids to college.
First-time home buyer, yep.
Yeah. So some big events that you would normally want access to the money are already built into the system.
Yep.
And those are, correct me if I'm wrong, those are standard. Like those are pushed down from the statute into the plans generally. They have to offer those three.
Right. And then there's the option for a loan. So some of the plans will offer a loan, and that's optional based on the employer.
Right.
But if you have a loan, then you can take up out of $50,000, up to $50,000 or half the value, whichever is smaller. and get that in a year, and then you pay it back with your paychecks automatically over the next 2 to 3 years,
Right.
depending on the company. So
those withholdings aren't tax-free, though. You'd still pay tax on the money you pay back the loan with. There's the Roth
for the 401k plan too, if you do take out the 401k loan and you end up leaving the company or are terminated with the company, you do have to pay off the loan, right, within a certain designated time period. It used to be within 60 days of termination.
It's still 60 days. That's right, and then you're doomed, man. Then you're doomed. So you
Yeah,
have to
I think they may have changed. They may have changed that rule to push it out a little further than 60 days with the COVID pandemic. So the rules around that have changed a little bit, but you do have to repay it. And if you don't, it becomes income subject to that 10% penalty.
Right. So if you're too young, then you have to pay a penalty on it too. Yeah, that's the way it works.
And the other thing I was throwing out there was the Roth 401k.
Yeah, so the Roth 401k is great too, and that's something we should talk about. You know, maybe just ask at the very basic level now. So what's the difference between the deferred 401k and the Roth, and why would I ever want to do a Roth?
Well, the Roth advantage is you pay the tax now, presumably when you're at a lower tax bracket. Like if you're a new wage earner, you're fresh out of college, you're not making major money yet. Same rationale behind a Roth IRA. You're paying the tax now, putting the money in, it grows tax-free, and it comes out tax-free.
Love it.
There's another one.
There's no required distribution.
Yep, no RMD.
No RMDs.
That's a big deal.
And I believe with the Roth IRA versus a Roth 401k, you can get more into a Roth 401k than you can into a Roth IRA.
Yeah, you sure can. Right, because you can put that. What was the number, Mike? That your max contribution in a 401k?
19,500.
And then if I'm over the age of 50, what's our catch up?
And if you're over the age of 50, you get another 6,500.
So that's a lot of money I could tuck away compared to the IRA contribution limit, which is much smaller.
Right.
Let's talk about IRAs. So how much can I put in an IRA, Mike?
You can put, I believe it's, well, again, it's going to depend on your age, but if you're 50 and under, I believe it's $6,500 right now.
Yeah, it's pretty small.
If you're over the age of 50, you can put in $7,500.
Yeah.
Subject to how much money you make. There is an income limit. If you make over a certain amount of money, I don't have those numbers off the top of my head, depending on whether you're filing single, joint, or head of household. If you exceed those income levels, you can't make a deductible IRA contribution.
We'll make sure to put the link to the website for all those numbers in the show liner notes so that everybody can see them.
Yeah.
So the IRA, I often get this question, and that is, I've got a deductible IRA or a Roth IRA, right? And so they work kind of similar to a 401k in that regard, right? I can either get a deduction or I can get after-tax dollars. Yeah, so that's pretty cool. So, but I can't put as much money into the IRA. So how do people end up with a lot of money in their IRAs? How does it even happen?
They change jobs. I mean, this is where you see a lot of $1 million IRAs is when people have built up a large balance in their company's 401k. They leave their job. They don't like the investment mix. I mean, it gets back to that kind of fluidity of investment options. They can, like I was saying earlier, a termination event is a rollover opportunity. You basically just take the money out of your 401k account and roll it into an IRA, and then you have much more fluid investment options, including what is often referred to as self-directed, which gets you into the gold and the real estate and all that fun stuff.
Right. So IRAs can get big after you leave employment.
That's usually how they get big.
And you could have more than one 401k, but why would you ever want more than one 401k? Isn't the destination place for the 401ks a single IRA when you're in retirement?
Yeah, I mean, the one advantage, and I'd have to see if, I honestly can't recall if the law has changed on this, but 401ks provided an additional asset protection benefit because it is a trust. It is a asset protected trust of the company. So if you go bankrupt, they can't go after those assets. An IRA is different because it's self-managed, it's your money. I don't believe IRAs in some states have the same asset protection as the 401ks.
So if I go bankrupt as a person, my IRA could be subject to the bankruptcy?
Correct.
Yeah, that would be a bummer. But wouldn't my 401k also be subject to that if I go bankrupt as a person?
No, because you're just a beneficiary under a trust. You don't have an actual ownership interest in the account.
So I better take care of my finances if I'm going to have an IRA, right? Don't go bankrupt.
Right.
Yeah, generally speaking, that's a good idea.
Generally speaking.
Makes sense. So IRAs, they can be Roth or they can be traditional, right, with the deferred. What about making money go Roth? What about doing a Roth conversion? Tell me about that. Pros and cons of that, and how does that work?
Well, I think you're the best one to answer that question.
You're right. It's kind of a leading question there. But yeah, Roth conversions can, they can cost you money in the short term, right? Because you're going to pay income tax on every dollar you roll over. Every dollar you convert from a traditional to a tax-free Roth is an income taxable event. You don't have to move all that money over right now, but you can choose how much to move over to keep yourself within a certain tax bracket.
So that's a question I'll ask you, because I know a few years back you were allowed to spread the income out over a couple of years. That's
Right.
gone away, correct?
It has, yeah. So a few years ago, if you did a really big conversion, let's use a number of 100,000, then you could spread it out over a couple of years. So you'd have 50,000 this year and 50,000 next year, but you did the conversion all right away. Today, if you did that same 100,000, you'd be taxed on 100,000 in the same.
Now, can you piecemeal a conversion?
Yeah. So you could have, let's say, you have 100,000 that you want to convert, then you just divide it up under 2 years or 3 years or however many years you want.
You just run the risk that the stuff that's left behind continues to grow, so you kind of can exacerbate your problem.
Right, and it'd be good if it grew.
Yeah, growth is good.
Growth is
But
good.
then the advantage to doing the all upfront conversion is you get all that post conversion growth captured in tax free
in the Roth.
Right.
But you wouldn't want to jump into a higher tax bracket, right, Mike?
Right.
Right. Yeah, and you're not going to have a 10% penalty for doing that rollover either.
That's a really
So the rollover doesn't trigger any penalties.
Right.
So that's a good deal too. And if you're looking at, if you're in current situation, right, we're probably in one of the lowest tax times we're going to see in a while. I think the tax rates are going to go up here eventually. And that's where the strategy comes in, right? Well, geez, my tax rate now is 20%, right? And maybe it's going to go up to 30% next year. Maybe now's a good time to roll it over. Or Karl, I know you probably do a lot of this planning too, is I've got a large loss I can take on some stocks. Let's offset that with an IRA rollover into a Roth. Plan that out so that you're mitigating, the tax effect of converting that Roth.
Great ideas. Great stuff. Hey, Mike, I got a question for you, or Nate, either one of you. So now we're talking about some really good planning and the situation that we're in right now, and it could be higher tax rates in the future. But one of the things that's being bantered around, and none of us really know what's going to come out of Congress, are long-term capital gains and short-term capital gains. And one of the questions we're often fielding in our office is, well, should I do a Roth conversion, and what if they raise long-term capital gains rates? But when we're talking about a retirement account, they got nothing to do with long-term capital gains and short-term capital gains. Am I right about that? Can you explain why not?
Yeah, a qualified plan account, whether it's an IRA or a 401k, is a tax-exempt vehicle. So it's as though you were investing in a charity. There's no gain or loss recognized. And the loss side is an important part of that. You're not going to get any offsetting losses inside of a 401k as well. So, but your account is not taxed on any of the gains. What's happening is that entire account balance is treated as compensation that once you start pulling it out, is taxed at that point in time in your retirement as ordinary income received as compensation, essentially effectively W-2 equivalent compensation.
So we don't need to worry about the capital gains rates if we've got the majority of our money in a retirement account. That problem is not our problem.
Right. So mutual funds you may be investing in, you don't need to worry about a long-term growth strategy versus an income strategy. It's all the same in terms of you literally can chase return. Not that I'm
once you're in the
that.
IRA.
When you're in the IRA, you
Right.
can chase return.
You can make what's a good investment decision for your situation.
Right.
Mike, anything you want to add on that?
No, I mean, I think Nate's got it right on the head. It's when you get to the point where you got to take the money out, that RMD piece, right, just hits you and you've got to take it out. Then you're just looking at ordinary income tax rates. There's no capital gains treatment on that money.
No, thank you so much. That's a common miscommunication we have. Because there's so many different types of taxes. All right, so I want to ask another, what might be simple to you guys questions, but when do I have to force money to come out of this account? And what is this? It didn't used to be age 70 and a half, but now it's age 72. What is that about?
people are just living longer. So,
Yeah.
so they moved it from 70 and a half to 72, and now they're even talking about maybe 74, 75.
So it's a required
I'm
minimum
taking your retirement
distribution,
distributions.
right? And the required, and so I have to do a required distribution at age 72 for deferred accounts, but I don't have to do it for the Roth, whether it's Roth IRA or Roth 401k, right?
Well, the policy objective behind it is they want to eventually force revenue into the coffers of the government. On the Roth, they've already collected it. They got their tax up front, and no amount of accelerating it on the back end is, in theory, going to produce more revenue for the government. I mean, conceivably, once you force it out of the Roth IRA, they'll reinvest it in an after-tax account and create some revenue that way. So I wouldn't put completely beyond the parallel or the beyond this government's prerogative to force people to get money out of a tax-free growth environment, but they haven't as of yet.
Love it. Thanks. That's
It's
really
just
important.
after you
I was gonna
die,
say
your heirs have to take it out. But
I was going to say, they can always go back and rewrite the taxation of the Roth, right? They can come back and go, oh, Roths are going to be taxable effective this date. So they can always change that. Right now, Roth's a tax deferred vehicle, but they can always go back and change that.
Yeah, that'd be a bummer, man.
That'd be a real bummer.
Okay, so two more questions, and that's that, and they bring up the other types of taxes that can be affected. But the first is what happens when I die, and then relatedly, and we can talk about them separately or together. What happens if I inherit one of these retirement accounts? So what happens when I die when I own an IRA?
nothing really. It just transfers to your heirs, and they can either. It's ordinary income to them. It's what we call income in respect of a decedent, IRD. And the most recently with the Secure Act, this was at the end of 2019, I think we have a podcast where we talk about this. No longer can you stretch that out over your lifetime. Now they're forcing you to take that out as an inheritor of an IRA over 10 years. Doesn't mean you have to take it out pro rata over 10 years. You just have to take it out by the end of 10 years. So that's what happens. You don't get a step up in basis. You don't get all the normal bells and whistles that come along with dying with an asset. It just transfers as an income in kind to your heirs, and they have to recognize that income.
Mike, anything to add on that?
That is 100% correct. Can't add anything to that.
So now let's say I'm one of the. One of the things I might add would be that you probably better name your beneficiaries, because if you don't, then it's going to go to your estate, and then you got to figure out how it's going to go from there. So it's a really good idea to take the time in your IRA to actually name the beneficiaries on your IRA account.
And I will say there's one exception to that general rule, which is spousal rollovers still apply. You still
Talk about that.
So a spouse can treat an inherited IRA, whether directly or indirectly received. There are some trusts that will qualify as spousal IRAs. Can roll it over and treat it as though it was their own, so it gets subject to their RMD requirements and that sort of thing. And then they can leave it according to beneficiary designations or their will.
All right, so inheritance by a spouse, it could be easy. But what about for the other beneficiaries? So now I've inherited an IRA. Don't I have now an obligation to do something? And isn't that pretty complicated? Because now I can't just defer it forever. I have to do I have to take income in respect to the decedent. I basically have to take income on the government schedule in an inherited IRA. I've got a forced distribution on my IRA that I've inherited, and I can't combine the inherited IRA with any other account. I have to leave it as decedent's name, beneficiary, my name,
Right.
and pull money out according to the government schedule. Now I could get rid of it. I could take it all at once, but then I have to pay income tax on all the way. So there's special rules for an inherited IRA unless you're a spouse.
Correct. Now, just this is a question for you. Can you do a conversion on an inherited IRA? No. Okay.
No, that's another thing. So you can only do the conversions on your own accounts. You can't do it on an inherited account. Bummer.
Yeah.
Wouldn't that be great?
But if you pull the money out and just invest it, offset anyway.
Yeah, right. At that point, then you're doing your own personal financial planning.
Right.
Yeah, maybe the inherited IRA pays for the taxes on something else you want to do.
Right.
Well, that covers the basics that I wanted to cover in the basics of retirement accounts. Anything else you guys can think of? Any common questions you receive?
Well, as you noted, I can't remember if it was while we were live or prior to, the fact that financial education in our current culture is not strong, and getting your children, your grandchildren, whoever it is you have influence or who's in your circle of influence, aware of these types of tools, getting them started early in not only just saving. I mean, saving was how our grandparents thought about it. They didn't have these tools available. It was just putting money in a bank account or in a shoebox or under the mattress or whatever. But saving was the principle. Here you're saving with kind of a tax purpose to it. That tax-free, tax-deferred growth is really the power of the tool. And I suppose you would have all sorts of illustrations that show I think the standard illustration, if you put $200 away per year, per month, or whatever it is, and what that amounts to by the time you're 65.
It could be millionaires.
Yeah,
it can be millions. It can be really, really fun if you forego Starbucks once a week, and you're a teenager. You'll have a couple of $1 million by the time you want to retire.
Yeah, it's hard to start to save for retirement when you're 55.
Yeah, the same amount of money you'd have to tuck away would be tens of thousands of dollars a month.
Right.
Yeah, it's a huge difference. It's a huge, huge difference. I think I'll forego Starbucks for my teenagers.
I think I'll never retire.
One of the things, we hope you don't, at least not in the near future. Well,
hey, Nate, quick question for you. You can't take an inherited IRA and roll it over into a charitable remainder trust?
No, you'd have to recognize the income. There's no way to, a deferred income item can never be converted into a charitable remainder trust. It triggers income recognition at that point in time.
That brings up a great topic for a future podcast where we'll talk about the basics of charitable contributions. Well, gentlemen, it's been great to talk with you gentlemen today. I really appreciate your time and expertise. And I look forward to talking to you again real soon.
Thank you. No, it's been a great conversation.
Thanks.
Create a beautiful day. Thank you for joining us today. Hope you enjoyed the information we shared.
If you enjoyed this podcast, please feel free to share it with someone else. And join us next time.
If you want to meet with a member of the team, please contact us at info@expertnetworkteam.com. That's info@expertnetworkteam.com.
If you have special topics you'd like to hear about, please reach out to us and let us know at the same email address. Again, that's info@expertnetworkteam.com. Thank you for joining us and have a great day. Thank you for listening to this podcast. We want to remind you that listening to this podcast does not establish a client-professional relationship with any of the firms represented, nor does it constitute legal, investment, or accounting advice, and the views are those of the professionals only.
Investment advisory services may be provided through A&I Financial Services, and securities may be provided through Genios Wealth Management.